bit later in the show. All right, turning back to the markets, the dollar index up about 0.5% this week, on pace for its biggest weekly rise in about a month as the conflict between Israel and Iran fuels an appetite for typical safe havens. However, the dollar, it's still lower this year, down this year, well, just about 9%, as concerns about the impact that tariffs could have on margins, corporate earnings, and overall growth, that just continues to weigh on the greenback. It's down about 1/3% right now. With that, let's bring in Phil Strebel, Chief Market Strategist at Blue Line Futures. Phil, good morning. Good to see you.
Thanks for having me on, Frank. Yeah, dollar's being held back by some uncertainty here. And frankly, being down 8% is just a scratch.
So you're saying you're calling it just a scratch like Elon Musk. So it's actually down more than 9%. But I want to get to the action this week in particular. So I think a lot of people are saying people are piling into the dollar as a safe haven, but you're saying it's something a bit different. You're saying it's some short covering and just also a bear market bounce.
Yeah, I mean, technically, essentially, it peaked on January 1st at 110 and then February 3rd at 109.75. Since then, it's just been a series of lower highs and lower lows. Simply put, the dollar index is in a bear market. Technically, where would this market need to turn around in order to get a neutral trend? Really, it's got to get over about 99.36. We'd probably run into 100, but I anticipate traders would press the downside under the premise that the bounce is just a bounce in a bear market. You know, since the beginning of the year, it's the political uncertainty, the tariff headlines, and also speculation that U.S. authorities really are quietly favoring a weaker currency. So it's fueling a rotation. And you look at the currency, the composition of foreign exchange reserves. This is put out by the IMF quarterly. The dollar in 2001 made up about 71% of most central banks, foreign central banks, currency reserves. If you bring that back to 2025, it's quietly drifted lower to about 57%, followed by the euro, the yen, and the pound. It's been the world's reserve currency for about 80 years. So the reason for the rotation, they're taking down this, and that's where selling dollars is taking place, is the U.S. fiscal trajectory is just unsustainable. It's most likely solvable, so default risk is relatively low. And where are these central banks rotating? Well, they're obviously adding gold, they're adding other asset classes, and it's brought together that way.
Let me ask you a quick question, then we got to go. A lot of talk about the big beautiful bill and some of the implications it has on not only the deficit but also tax policy here in the U.S. How does that impact the dollar very quickly?
Well, the problem is that the Federal Reserve doesn't know what's going to happen. So they're looking at these different spending measures and things like that, and they've got to hold higher rates for longer because of the fact we've got this geopolitical uncertainty and the tariffs. So you're going to see it held back by that uncertainty until we get clarity on this big, beautiful bill, Middle East conflict, and also tariffs. Then the dollar index can resume its rally.
All right, Phil Strebel saying the level to watch on the DXY, I believe you said 99.30, so we're going to continue to watch that. Great to see you, Phil. Thank you very much.
Yeah. Thanks.
All right, still on deck here on Worldwide.